Welcome to Crescat's Market Call, featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please read through our important disclosures being shown now. These and additional disclosures regarding the risks involved in the type of investments we will be discussing, as well as the fund's performance, can be found on Crescat's YouTube channel or on our website using the QR codes on the slides. The type of investments discussed on these videos can carry significant risks, including risk of loss. The videos are intended to be general discussions of macro investment themes, the mining industry, and news with respect to the companies in our activist metals portfolio, and are not intended to be investment advice or an offer of investment advice or services. Crescat's managed funds only accept accredited investors, and the discussion in these videos has been prepared with that level of audience sophistication in mind. Any forward-looking statements may or may not come to fruition. If you enjoy our videos, please click on the like button and make sure you are subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on X for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to our head of investor relations, Merrick Iwahashi. His contact information is on the screen now and can also be found on our website at crescat.net. All right, welcome everybody. So I'm here today with Nathaniel Gilbert. He's one of our analysts here at Crescat that's been with us for about 3 years now. And Quentin Henney is traveling. He's been in Saudi Arabia, in Riyadh, at a mining investment conference there, a big one, all week. And we will be very excited to hear what he has to say when he comes back in the next 2 weeks. So what we have here is Crescat finished a really strong year as of January 16th. So as of today, there are 765 hedge funds that have reported their performance to the Preqin database. There's more than 2,500 funds in the database, or at least there were when we last checked it. For our performance numbers through November, but so far we've got 800 funds that have reported their full year, and Crescat has 5 of the top 9 performing hedge funds in the entire Preqin database. So we're very proud, very excited to report that we finished an incredibly strong year, and you can see the precious metals fund is the best performing among our funds for the year. And our activist metals theme, which is the largest theme across all of our funds, it has been the primary driver of the performance in the last year. But all of our funds, the precious metals fund and the institutional commodity fund, those are very, very similar activist metals oriented funds. Number 5 and number 7, the long short fund actually outperformed the global macro and the institutional macro fund this year. But the global macro and the institutional macro funds also had a phenomenal year. We look forward to seeing more funds report and seeing how it all shakes out in the weeks ahead. Let's go on to the next. Our precious metals fund. This is one that we launched in August of 2020. It is our pure activist metals fund strategy. We also launched the institutional commodity fund, which is the institutional version of this strategy, because we reached our 100 U.S. investor slots in that our maximum number of U.S. investors that we could take in the precious metals fund. So we had to open it up to qualified purchasers in a different fund that's very similar, but is we call that the institutional commodity fund, and that is available to institutional investors, otherwise qualified purchasers, 5 million or more in net worth, and then we can take more than 100 investors that way. We're not limited in capacity, and certainly the precious metals industry and the mining industry, where we're focused, is not limited in capacity to take on capital. It is an industry, in fact, that has been starved of capital for more than a decade, since the peak of the last cycle. And Nathaniel actually has a nice chart that he's going to show on that, showing the CapEx cycle for the large cap mining stocks. We believe it's still very early in a new cycle for activist metals. Of course, this global fiat debasement theme has been the longest running theme at Crescat. You know, it's a macro theme that I first initiated as a dollar crisis theme back in the early 2000s, that evolved to a global fiat debasement theme, and it's the whole impetus for the from a macro standpoint for launching the Crescat Precious Metals Fund in August of 2020. But we think it's still early for a number of reasons, which we're going to be talking about. But you can see here that this fund has outperformed all of the benchmarks, the Philadelphia Gold and Silver Index, which is the large cap index, and Nathaniel's going to be talking about that one. Gold itself through the GLD ETF, silver itself through the SLV ETF, the VanEck Junior Gold Miners ETF, the GDXJ, which is really a mid-cap producer index, and the VanEck Gold Miners large cap GDX. So we're really excited about this performance. We believe it is one of the top 1 or 2 performing sector-focused funds among all sector-focused funds in the eVestment database, going back to inception of this fund, and we're very proud of this. Let's go on to the next. Just highlighting again, I know I've showed this in the past, but we just finished our 20 years of performance of the Crescat Global Macro Fund in December, and this chart needs to be updated through December, but it's showing it's updated through November, of course. But what we're showing here is the downside capture ratio. And one thing that's very unique about the Crescat Global Macro Fund and our institutional macro fund is that we are, we're a macro fund that is designed to be all weather, all markets, bull markets, sideways markets, down markets. And what the downside capture ratio shows is how our global macro fund over 20 years of performance has performed in down markets. Negative downside capture ratio, what it reflects is that on average, our funds have gone up in down months in the past, in down markets for the benchmark, whether it's the S&P 500 or the HFRX Global Hedge Fund Index. When the markets have gone down, on average, our fund has gone up. That's the meaning of a negative downside capture ratio. So low downside capture is good. Negative downside capture is even better. Let's go on to the next. And this just shows that among the roughly 115 or so funds that called themselves global macro discretionary macro funds that launched at the same, or that were around at the same time as our fund launched in January of 2006, there's only about 15 or so of them still around today. And our fund, our global macro fund, has the best performance on 2 different dimensions here, both absolute return, net annualized performance, and downside capture ratio. This is, I know I've shown this before, but for new people that might be watching, this is just something that's very important to point out about our global macro fund, because we believe we're at record valuations for the S&P 500 and the mega cap tech stocks, and we believe there's significant downside risk in this market, and we're the type of fund that I believe can do well in down markets, and this is just kind of showing the historical evidence of that. But I'm determined to do well in down markets going forward. Let's go on to the next. And why are we concerned about this? I know I've shown this before for those who've been with us before, but for new people, NVIDIA, we believe is the poster child for the bubble stock of our time today, for the AI bubble. And what we're showing here is simply on an enterprise value to GDP basis, the enterprise value of NVIDIA relative to GDP at NVIDIA's recent top on October 29th was 16.3% enterprise value relative to GDP. Now this is more than twice as big as the three largest vendors to the internet bubble in 2000, Cisco, Intel, and Sun Microsystems. A lot of people think, oh, it's not, this current environment that, for AI, it's different. It's not the same as the .com or the internet bubble in 2000. We contend that it is very much the same in the sense of being this overvaluation and overinvestment. A lot of people will say it's not the same because the companies in the .com were not profitable. Cisco, Intel, and Sun Microsystems, the vendors to the internet, were not unprofitable companies. They were extremely profitable companies back in their day. They were extremely global companies back in their day. A lot of other people will say, well, oh, EV to GDP. GDP doesn't matter because today's hyperscalers and vendors to the hyperscalers are they're global companies today. Come on. Cisco, Intel, Sun Microsystems were global companies back in 2000. GDP is a valid comparison. We could do global GDP. It would show the same thing. So let's go on to the next. And this is, again, showing the top 10 mega cap tech stocks back in the .com bubble, all very profitable companies back in their day versus the top 10 today. And we have a bubble, once again, that is more than twice as big on a valuation basis. So look, folks, it's all about the CapEx cycle. If you want to learn more about what that means, go subscribe to Michael Burry's Substack. Read some of his information on that. It's very similar to the information that we've been sharing and some that Nathaniel is going to show you here pretty soon as well. Let's go on to the next. So this is a new thing for Crescat, and I'm happy to talk about our equity quant model. Once again, many of you will remember, who are long-term clients who know me, know that the equity quant model is something that I've had and that's been behind Crescat for going back all the way to before Crescat was even founded, because it's something that I developed first on my own when I was working as a broker for Kidder Peabody, and then later as I worked for a small broker dealer here in Denver, Colorado, that became the predecessor to Crescat, where I debuted my equity quant model. We launched a whole large cap strategy around it and the long short equity hedge fund around it in 2000. It has been behind the scenes, with me for 30 years. And so we're going to be featuring a lot more about our equity quant model in the months ahead. But this is just a preview because over the last 5 years, we've been taking my model and we've been getting it fine-tuned for AI. And in the past year, we've had full AI operating under the hood and behind the scenes within my equity model framework. So just an overview to kind of show you how it works. There's about 65 underlying fundamental and technical factors that go into our equity quant model. There's about 9 different layers that we call the factor categories. These are input layers, the 65 underlying factors plus these other factor categories. They feed into a neural network that is in the cloud with Google TensorFlow behind the scenes, and it's up on Amazon AWS, and we have, behind the scenes, we have the AI neural network layers, the input layers, the hidden layers, the output layers, and it all feeds back into our own Crescat output layers, the familiar construct of the model that has evolved and been with me for 30 years. So we have the all equity scores, the within type scores. We do our own typing. We have our own DNA typing that we do of the different stocks in our universe. We have within industry scores, and we have what we call our historic scores, which is a proprietary thing that I'm not going to get into right now. And overall, it feeds out into an overall Crescat score as a final output. So let's go on to the next. So why am I excited to debut some of the model information to you today? And I apologize that some of this might be small, but what I really want to show is that the large cap and mid cap, which is stocks, U.S. listed stocks, which are part of our 2,200 U.S. stock universe that we score in this model, that among the top scoring stocks in our universe today are overwhelmingly the large and mid cap gold and silver miners. And so you can see here the overall Crescat score that comes out of this multi-layer AI neural network model, our own proprietary model. We have, you can see at the very top, Agnico. So now we're just looking at the materials sector. We have it filtered by the materials sector, but overwhelmingly you can see among our 2,200 stock universe, the top, which at the end in our output layer, we score them from 1 to 100, from 0 to 100 actually. And so 100 are the top scoring stocks in our model today. And overwhelmingly among the top scoring stocks, I mean, look at them: Agnico Eagle, Anglo Gold, Barrick, Centerra, Goldfields, Kinross, Newmont, SSR, First Majestic, and on down. These are the stocks that are scoring 97 and above, 97th percentile and above in our 2,200 stock universe. Now, these stocks have been scoring well all year, and that is why this has been the best performing industry in the market in 2025. But what I'm trying to show you here is that that forward outlook, and this is what Nathaniel is going to show you more as well, the forward outlook for these companies is still outstanding. The valuation, the growth opportunity, the ability to catch up to the metals prices themselves. I mean, a lot of people will say, but Kevin, gold and silver have already run, so much. Why should I buy gold and silver, here? Well, there is a lot of catch up just to come up to the current levels for gold and silver prices still within the mining stocks. And that is what our model is showing here. And there is even so much more to catch up in our activist metals portfolio, where we are involved in the smaller cap segment, the exploration and the development side of the mining industry. But why? So why are we showing the large cap stocks here and And we do have some of these large cap stocks in our portfolios across Crescat too. But the smaller cap ones have even better valuation and even better growth. And this is what we're trying to ahead in our model. In our view, this is what we're trying to show. Let's go on to the next. So here's a single stock view of our equity quant model. And yes, we blurred out a lot of the factors here, which are proprietary, including our overall AI weights and our AI scores, which you can see in the far right. But it's just to illustrate that we have these 65 underlying factors which are being scored and ranked, and it's just an illustration here, showing Newmont, which scores in the 100th percentile right now among this 2,200 stock universe, and across these different factors. We talked about the typing a little bit. You can see that in our DNA typing of the equities in our universe, Newmont is classified as a defensive type. So I don't want to dwell on this too much, but it's a combination of value factors, growth factors, quality factors, what we call omega factors. That's proprietary fundamental dynamics scoring that we do, insider buying and selling, earnings, sales, and free cash flow dynamics, capital allocation factors, balance sheet factors, short interest factors, technical factors, and overall we run it through all of the different layers that we showed in that first slide to come up with our final scoring. Let's go on to the next. Okay, so I'm going to turn it over now to Nathaniel, who's been with Crescat for 3 years now, and he's one of our superstar young analysts that is going to talk more about both the macro environment for gold and some of the fundamentals among the larger cap stocks, and then we'll come back to me to finish up and translate it more into the smaller cap mining equities. Take it away, Nathaniel.
Yeah, thanks, Kevin. So 2025 was a fantastic year for the miners. I think everyone here knows this. They saw massive price appreciation. And you might ask yourself, can we expect to see that again in 2026? Well, let's take a look here at the 12-month forward EV to EBITDA ratios, all right? And I want you to focus on the green and blue dots, okay? Green is where their current multiple is. The blue is their 10-year average. And you can see it's pretty close to where those two are pretty close at the moment, even after this incredible run-up we've had over the past year. The miners are still looking relatively inexpensive. And we believe that there's still a lot more room for these companies to grow. If we go to the next slide, part of the reason that they've had such good performance over the past year, of course, is the price of gold. And what's been driving this? Well, one of the major drivers has been central bank buying. This chart right here is showing US dollar versus gold as a percent of global reserves in central banks around the world. And you can see back in the late 80s into the early 90s, gold was actually a larger proportion of these reserves. And then the dollar took over, dollar dominance, but there's been rising geopolitical tensions, there's been debasement, devaluation of currencies, and holding fiat currency is becoming less attractive. And there's been a shift, as you can see, starting in 2022 with a really dramatic increase in the central bank holdings of gold. And that has been driving a lot of the price appreciation. And this is a long-term trend that we believe will continue. And I think that will help gold, continue to perform throughout the year. Now you can say, okay, gold was up whatever percent last year. That's got to be contributing to the rise in the percent of the reserves. Yeah, that's true. But this is looking at net quarterly purchases of gold by central banks. Net meaning, they take what they bought less what they sell. And again, since 2022, we've seen a very elevated buying. And that's kind of what has been driving this trend. Now, another part of why the miners have performed so well is that while gold has been rising, their costs have not risen in tandem. So all-in sustaining cost is basically how much it costs to get an ounce of gold or gold equivalent out of the ground. For example, the raw number for Newmont right now is about $1,500 per ounce. That's how much it takes for them to get an ounce of gold out of the ground. This right here is looking at the year-over-year growth of that raw number. And the red line is the median. As you can see, over the past couple of years, it's been pretty steady, and we even have the 2026 estimates in here as well, which is sitting at about 5%. So what does that mean? Well, if we were only expecting a 5% increase in their cost over next year, right? Any more appreciation we get than that in the gold price is just profit, right? We'll continue to see them making more money. And we'll go on to the next. And this is what happened. Now, this chart right here is showing the major's net debt position. For those of you that don't know, net debt is basically all of the debt and liabilities less cash or cash equivalents. So when you have a negative net debt position, that means you have enough cash or cash equivalents on your balance sheet at the moment to pay off all of your debt and still have some left over. And right now, or I guess it would be as of Q3 2025, the majors have been sitting on a historic cash position we've not seen in a long time. Again, because of this rapid appreciation in the gold price and keeping their costs low. What does this mean? Well, they can afford to go on a buying cycle. And they've done that in the past cycles, and they've been a little reckless, and they got, let's say, punished for it. So this cycle, they're being a little more conservative, but they do have the healthiest balance sheets they've had in a very long time. And that's leading us into this CapEx cycle that Kevin was alluding to earlier. So looking back, you can see CapEx peaked in about, let's say, sometime in late 2013. But during that cycle, the gold price, or not, the miners peaked late 2010, early 2011. So the CapEx spending continued even as prices were declining. And that's kind of what we're seeing right now, or expecting to see with mega cap tech. Again, these CapEx cycles are something that we cannot be ignoring. And right now you can see that we're just at the start of one. And I should have mentioned that this chart is adjusting billions of dollars into today's dollar amount, right? Adjusting for CPI to today. And anyways, we're at the beginning of another one of these CapEx cycles. So we have the majors sitting with the best balance sheets they've had in a long time at the very beginning of another CapEx cycle. And I think this is an interesting little snippet I found from Bloomberg Intelligence that really highlights that it is much cheaper for majors to find the gold going after early stage acquisitions or early stage projects exploration rather than buying, producing mines. And there's a reason for this, right? It's because those project stage companies, their value is suppressed incredibly. And Kevin is going to talk more about that. I think that's all I have. So I'll hand it back to you, Kevin.
All right, thank you, Nathaniel. So, that last slide that Nathaniel was showing is very interesting because it was showing that compared to the cost of discovery, the cost of drilling and discovery, which is where Crescat has been focused in its activist metal strategy now for the last 6 years. Is much cheaper than a company coming in and buying a late stage project, that is ready to go into production. And so let's go on to the next. So, because that segues really nicely into the Lassonde curve. So this is a depiction of the Lassonde curve. We call it also the Crescat curve because it's showing here where we like to come in and where we like to exit. And so the life cycle of a gold mine is what this chart is all about. Pierre Lassonde gets all the credit for it. He drew this thing on a cocktail napkin, then he wrote a whole book about it. And what's very interesting is that Pierre Lassonde became a billionaire basically on the left-hand side of this Lassonde curve with his big, gold strike discovery in Nevada. But he likes to talk about, why it's also great to come in on that development side, kind of at the low point here, after a project has already been fully drilled out and has had all the mining engineering studies and is ready to go to getting ready to go into production. You typically have this, you go through this orphan period where we have all this excitement in the drilling and discovery phase. Stock price appreciates rapidly, and a company will either get taken out kind of near the peak of that left-hand side of the curve, or it will slip down the middle part of the Lassonde curve. And because all those investors who were in it for the excitement of the drilling and the discovery, if it doesn't get taken out, well, then you're facing the hard yards of actually, doing all the engineering work and raising all the capital to actually go and build a mine. And you get this orphan period. I mean, some of our clients will know that we've been able to not only clock out of some of our companies at the peak of that Lassonde curve, and all of the excitement, but we've also some of them peaked a lot earlier than we thought they would have, and they slipped down the curve to become more on the development side. But we've had many successful exits, near the top of that curve, including many companies that ultimately were taken out, even though we might have gotten out even before they got taken out. In the case of a few of them, like Great Bear, for instance, but and some others. But let's anyway, we like to focus on the left-hand side of the Lassonde curve, but we're also interested in development stage projects too. And this is where the real value is. So we showed you across our equity quant model, across some other charts that Nathaniel showed you why it's still a very early stage environment for the large and mid cap gold and silver miners. There's still great valuation, still great growth ahead, a lot of catch up to the gold price. But we believe very strongly, according to our modeling, that there's even better value and better growth and better appreciation potential in the exploration and development stage, both the exploration and the development stage, like that Bloomberg Intelligence slide was showing, but especially in the exploration stage, where we have really developed a niche. Let's go on to the next. So this is actually a chart that Nathaniel did much of the work on back in the day, 2024, and it's showing that at the median, gold exploration company, an explorer, at the median, historically, when it gets taken over by a major mining company, gets taken out at 17% of the resource value in the ground. In bull markets, they get taken out at even higher. But at the median, it's 17%. Why did we do this chart? Why did I have Nathaniel do the work to produce this chart? Because Quentin helped us, validate all of the data behind the scenes. The reason we had him do it is because there's this old wives' tale, this old in the industry that, if you go back to the other chart, Trevor, there's an old the Lassonde curve chart. There's an old wives' tale that at the peak of the Lassonde curve, if an explorer trades up to 20% of the resource value in the metal in the ground, that's it. That's the peak of, on average, of that left-hand side of the Lassonde curve. And so we wanted it, but the same wives' tale is that that's the average at which the majors will come in and buy them at. So we had to do the work to kind of prove that out. And yeah, at the average, it is around 20% if you do just an average. But we decided to be a little bit more conservative and use the median, and the median is 17%. Let's go back to that chart. So why does this matter? It matters because our exploration portfolio of companies is trading at a substantial discount to this 17%. I mean, I can't even tell you how much cheaper it is. You'll have to come back and watch a one-on-one presentation for me to show you, because I would be in violation of the SEC marketing rule if I told you how much crazy appreciation potential there is ahead compared to our portfolio based upon Quinton's geologic estimates of the potential resource, the target resource, based upon the drilling progress to date. There's such a difference between the valuation of our current portfolio versus the 17% median, and I believe it's substantially deeper value, substantially higher growth and appreciation potential ahead than there is even for the major and mid-cap gold and silver miners that are quant modeled across all those different fundamental and technical measures, is scoring at the top of our rankings today. What we're trying to tell you folks is it's still early. It's still very early in the cycle for precious metals miners, and this is where all the catch up is, not just in the majors. Yeah, it's great for the majors, but small cap explorers and developers, and especially the best small cap explorers and developers, which is what we have been cultivating and curating now for the last 6 years. Let's keep going. And so this is a top-down snapshot of our activist metals portfolio. We've got about $512 million invested across the firm, across this portfolio today. If you look across the left, across the top, current gold prices are $4,600. This was our macro thesis that's been going on for several decades now at Crescat. Global fiat debasement. We have macro imbalances, the deficits, the debt, the money printing, the necessary inflation to get ourselves out of this debt. We want to own hard assets. We want to own real money. And at the same time, these are industrial metals: gold, silver, copper, critical metals. Critical and precious metals are, all of the precious metals are also critical metals. All the critical metals are the base metals and the precious metals. The world needs metals. We need it for the central banks. We need it for the industrialization, the data centers, the electric vehicles, the AI, the defense. This is what the world needs. But there's been underinvestment in this industry, as Nathaniel's CapEx chart showed, for like 14 years. We're still early in this very long CapEx cycles. Just like we're late, like it's the late innings in the CapEx cycle for mega cap tech. And remember, mega CapEx keeps going up. The stocks peak first. The CapEx keeps going, just like it did for gold stocks, just like it did for tech stocks in the 2000 tech bubble, just like it is almost certain to happen right now and is happening right now for the AI bubble. But the stocks will peak first. Has NVIDIA already peaked? I think it probably has. And look, I'm getting off track, but I'll come right back to the activist metals portfolio. We had Cerebras or Cerebras or whatever it's called. look at the news in the Wall Street Journal yesterday. Sam Altman, OpenAI, he's done a deal with Cerebras for computer chips. Who the heck is Cerebras? Well, go back and look at our letter from about 1 year ago when I wrote about it in that letter. So, you know, they have their Cerebras is an NVIDIA killer. Okay, they have an AI, an AI chip, an AI that is like 56 times more powerful than NVIDIA. Sam Altman is a backer of the stock. OpenAI just did a deal with them. The world, you know, NVIDIA is not the only company out there that's got dominant AI semiconductor technology. There is all kinds of competition. Anyway, so let's get back to our activist metals portfolio. You know, so on the long side, this is where the value, this is where the growth is, this is where the opportunity is. We have 79 positions across this portfolio. They are predominantly smaller cap and mid cap companies, but this is where the bigger growth ahead is in this industry. It's on the exploration side, as that Bloomberg Intelligence slide showed. There's much more value in exploration. We have had more drills operating across our portfolio companies for the last 6 years, than all of the major gold mining companies combined. And as a result, if you go back across the top here, among our 79 positions, we got 42 companies with bona fide discoveries using the Newmont criteria. We are going after big tier 1 discoveries. Most of our companies are public. 19 of them are still private. Several of the private ones will be going public this year. In fact, very soon. One of them, which was the story that Quentin teased you all about, Silver Company, 2 weeks ago. We have 34 positions where we own greater than 5% of the company. At the median, we own 9.9% on a partially diluted basis across all these companies. These are true activist stakes in big tier 1 targets: gold, silver, copper, zinc. We have currently over 116 drills operating around the world. You'll notice in the map where our exploration companies drilling and discoveries are concentrated. Look, you know, we've heard about the Monroe Doctrine and the new Trump Doctrine. You know, the Western Hemisphere. Look at how our companies are focused on the Western Hemisphere, from South America all the way up to Alaska, to the U.S. and Canada. Yes, we have some companies. Some of our companies are in Australia. We have one in Africa. We have some in Europe. But the military and security realliance that the Trump administration is going for, we are focused within that domain, very much so. And the punchline here at the very top of the chart on the right hand side, 323 million target gold equivalent ounces across our entire portfolio companies that we own 9.9% at the median, partially diluted. These are big new tier 1 discoveries that are super cheap in our model, with a lot of appreciation, catch up. So where's the catch up to gold? Yeah, it's the large and mid cap mining stocks. Nathaniel showed you why the margins are freaking phenomenal and likely to continue to remain phenomenal. But where's there even better value, even better growth? It's our activist metals portfolio. And we invite, let's go on to my final slide here. These are the disclosures around the activist metals portfolio. And now what should be the final slide. Well, I have 2 more. Okay, so this is just showing our top 10 holdings. and I'm not going to go into much of the details here, but I invite you to reach out to us especially if you're a new investor and are interested in learning more about Crescat and want to learn more about these companies. We invite you to reach out to us, and we can go through a one-on-one presentation and show you much more. But these are the companies that have the big new tier 1 discoveries, and these are the top 10 and incipient discoveries. In some cases, some of these are bona fide discoveries. Some of these are companies that are they're already producing, but most of these are new big tier 1 discoveries that are super cheap with a lot of growth ahead. Call us if you want to learn more. Let's see, my final slide is just inviting you also to go to our website, look at our performance. We show the performance across all of our hedge funds here in this table. There's even more performance, more disclosures, more materials up on the website. You can see our past letters. I know Crescat has Crescat is in a new phase of growth and momentum, in my opinion, that I believe has only just started in 2025, and there is a lot more to come, a lot more to go. We have a very long-term performance track record across the firm, so I invite you to go study it, learn more about it, and to reach out to Merrick, our head of investor relations, if you want to do that, if you want to learn more. His phone number's here, his email's here. So we look forward to being back with y'all in another 2 weeks. We are going to be featuring more of the Crescat team. Lars Thiel, our PhD biotech analyst. We are in the process of getting ready to launch an entire new Crescat fund around our biotech long sleeve, which Lars has been advising on for the past 3 years. And if you do the carve out of that performance in our global macro and long short fund, he has been beating the pants off of the ETFs and the other hedge funds and other funds that are focused on biopharma. So there'll be a lot more to come on that. We're also going to be featuring Lisa Theme, our oil and gas analyst, and we're going to be featuring Ryan, maybe even James from the quant. From the Crescat quant team behind that AI model, which they have been helping me to refine for the past 5+ years now. And of course, we expect to have Quentin back as well with further updates on our activist exploration portfolio. So thank you all for joining. We look forward to seeing you in 2 weeks.